Welcome to Lesson 5 from Accounting, covering Chapters 8 and 9 in this week's material. Chapter 8 discusses accounting for long-term assets. That would be equipment, plant, and land assets. Current assets are also referred to as working capital. They are short-term and are consumed or turned over in less than a year's time. Long-term assets, on the other hand, are used for more than a year before they are used up. Some assets, like land, have an indefinite lifespan and are never used up. Long-term assets can be tangible or intangible. Tangible assets can be seen and have a physical presence. They include property, plant, and equipment that are subject to depreciation. That is, they are used up over time, with the exception of land, of course. A second category is natural resources. Some, like lumber, are renewable. Others, like mineral deposits, are subject to depletion. Intangible assets can have limited life or indefinite useful life. A patent has a definite length of useful life until it expires. Trademarks can have useful lives that span centuries. For example, Coca-Cola. Been around a long time. When valuing long-term assets, accountants use the historical cost concept most of the time. Building valuation will include the purchase price plus sales taxes plus title and transfer costs plus realtors and attorneys' fees plus remodeling costs minus the accumulated depreciation of the building. Land is valued at purchase price plus sales tax plus title and transfer costs plus realtor and attorney fees plus remodeling costs minus the accumulated, I got off course there. Simply fees and the demolition cost of old buildings plus the grading costs, moving the dirt around. Equipment and machinery are treated similarly. Historical costs are preserved in the accounts separate from the depreciation allowances. Several methods of recognizing depreciation are allowed under GAAP. The simplest is called straight-line depreciation. The purchase price is divided by the number of estimated years of useful life, and that amount is recorded evenly each year until the asset is scrapped or sold. The depreciation is recorded as a contra account separate from the book value or also carrying value of the asset. When the asset is used up and discarded, any scrap value is recorded as a gain or a loss if the asset sells for less than the book value minus depreciation. These gains and losses are not recorded on the income statement as cash flows like regular revenues and expenses, although they are similar, since they are one-time events, which is how they differ. Thus, they appear under a separate heading as gains and losses in the investing section of the classified income statement. A second depreciation method is termed double declining balance. This is an accelerated write-off that reflects a higher cost of use in the early years of the asset's life and less in the later years. Under either method, no asset can be depreciated below zero. A third method is called units of production depreciation. This is based on the estimated production of the asset for its useful life and recorded as the asset is used annually. An example would be miles on a car. Since depletion expenses are not cash flows, they can be used to defer taxes from the current period as a result of lowering stated income. Since depreciation expenses are estimated, they are subject to revision based on shorter or longer useful life or a revision of the salvage value. When accounting for expenses on plant assets, some costs are treated as expenses, for example, repairs, and some are capitalized. This latter means that the value of the asset is adjusted by the amount of the outlay. and the recovery of that will then be spread over several years. Natural resources are depleted rather than depreciated, but the concept is the same. Trademarks, copyrights, patents, franchises, and goodwill are all examples of intangible assets. Goodwill is treated differently from the others. The chapter closes with a discussion of the effects of judgment, estimation, and industry characteristics on asset values and on ratio analysis. Chapter 9 covers the accounting for current liabilities and payroll. The key operating concept at work here is the going concern assumption. This means that the firm is expected to be operating and paying all obligations in full for at least the next year. This means that all liabilities will be recorded at face value. We have already discussed promissory notes in the earlier chapters. Other short-term liabilities include sales taxes, contingent liabilities, warranties, and payroll accounts. Each of these has its own particular twists, and we will discuss them in class. Payroll is especially complicated by a variety of mandated benefits that the employer must pay in addition to base hourly or salary pay. Some of these are required by the federal government, some by the states. If the firm is operating within the city, there may be city payroll taxes as well. And this, thankfully, concludes Lesson 5.